Welcome to your expert tips for buyers and sellers. I am Dolly Torres, your realtor and real estate coach, and I'm here with David. Once again, welcome, David. How are you?
Doing well. How about yourself?
I'm doing well. So, David, as you know, he's an account executive over New Fi Wholesale Mortgage. And today I wanted him to talk about a little bit about DSCR loans, how they work, what they are, um, why people normally go for that type of loan versus another loan. So, David, can you tell me what is a DSCR and how it works?
Well, DSCR stands for Debt Ratio Coverage Service. So it basically, when you're qualifying for the loan, it's not for investment property only. So it's a business purpose loan, which is good because that means it's a non-TRID loan or is not as restrictive from a regulatory standpoint, but it is strictly investment properties. And you don't have to qualify from an income perspective. Quite frankly, we don't want to see any income at all. No employment information, no income documentation, anything to that nature. The property does just as what the DSCR says, it debt services. So the property covers itself, cash flows itself, and that's how it qualifies for itself.
So, whenever someone is looking for a property, can a first-time home buyer use this type of program, or does he have to be a seasoned investor?
I guess actually no to both. It does. A first-time home buyer is ineligible. Okay, you cannot be a first-time home buyer, but you can be a novice or a first-time investor. So that means you have to at least have owned a home, and the definition of owning a home is you've had to own a home for 12 months within the last 36 months. So if somebody previously owned a home, sold it 2 years ago and have not, they're still considered a home buyer. They're not a first-time home buyer. They're a seasoned home buyer. But if they sold it 5 years ago and have been renting or leasing since, we're unfortunately going to view them as a first-time home buyer. With regards to a first-time investor, that is allowed. There's only a couple caveats because it's a little bit riskier of a loan, is that there's a 5% reduction to the maximum loan to value. And the minimum reserves goes from the standard 4 months to 8 months reserves of PITI.
And what is the down payment looking like?
The minimum down payment is 20%.
Okay. And so basically how I understand it is if you're thinking of purchasing a property and you want to go the non-QM route, which is going away from the traditional route, because you don't show enough incomes on your taxes or whatnot, and you want to purchase that property for rental purposes, then that property can qualify for this type of program because ultimately you guys get the rental amount to justify the mortgage payment. Is that accurate?
That is correct. So within the purchase, if they're buying a vacant property or it is currently being rented but then vacated out, because most new investors want higher rents or more market rents. If you have a seasoned renter in there, their rents may be below market. You might not want to carry those over. But what we do is when the appraisal goes out there, they will obtain also a 1007, which is a market rent analysis, and they're going to indicate what those market rents are. So we will look at that amount, and then your mortgage payment, taxes, and insurance is what has to be covered by that rental income.
So let me ask, so we can use this program to refinance a property, correct?
An investment property, yes.
An investment property. What about if they have been renting a property for a tenant for a while and their rental amount is not quite there yet? So what do you normally suggest that?
Well, okay, if it is a seasoned lender, or I'm sorry, a seasoned tenant, what you're going to have to do is they would either have had to up the rent, and we would need to get at least 1, preferably 2 months of verification that higher amount has been received. because the one thing that everyone is always concerned about is that people will modify information just to qualify for a loan. Okay, so but there's also times to keep in mind that somebody has had a tenant in there, they want to do some remodifications, and maybe the house is vacant for a little bit, and then they want to do it. At that point, if it makes sense, we will still do it and run off of market rents. But if there is somebody that when the appraiser goes out, somebody is living there, we're going to have to go by what the true rents are being received.
Got it. And how about if the true rent received it's higher than the rental analysis?
Well,
Which
it's
one
going
do they pick?
to, yeah, we're always going to technically use the lower of the two. However, if the current rents received are within 120% of the market rents, we'll go ahead and use it. If it's 150% of the market rents, we will bring it down to 120%.
Perfect.
So we will get that, but again, they're still going to want to see at least 2 months of proof that it's been received.
Now, 2 months, you said, right?
2 months, yes.
Perfect. So what is the minimum credit score required to apply for this type of loan?
Okay, so 700 will get you to 80% LTV, if that's what you're looking for.
Which means you would have to give 20% down payment
Correct.
in order to get the 80% loan to value.
80% LTV, correct. And that's at a 700 score. You can put 25% down and with a 640 score, but up to a loan amount of 500,000. If the loan amount's over 500,000, then we would need a 660 score to go up to 75% loan to value.
So what are the documents that someone would have to gather in order to get a pre-approval for this loan? Because as I understand it, there's no income document required. So basically just their social, their name, bank statements.
Right, it'd be credit score, source of down payment, proof of down payment, and a mortgage history. So if they have their existing mortgages, great. There are times where somebody, as you mentioned, may have other rental properties, but technically may not have a mortgage on their primary residence, or may be living, mortgage free, whether their spouse or family member or what be it, and that's fine. So we won't get that history, but we'll get a mortgage history. But that's basically it. You're going credit score, down payment, and 4 months reserves.
Perfect. And then if you are a new person, a new investor, you would probably have to have more reserves, which I believe is 8 months.
Correct.
If I'm wrong.
Correct.
And then your down payment would be a tiny bit higher, about 25%.
Yes, yeah, it would increase 5%. Correct.
Perfect. Okay. So what would be something to keep in mind whenever we are doing this type of loan? Anything major that comes up?
I would say it's just that you do have options. So, for example, when they're looking to purchase a home and you're looking at what market conditions might be, whether that be off of Zillow, Redfin, or what Rent-A-Meter or what be it. Sometimes when that 1007 comes in, it may come in either higher or a bit lower. And if it doesn't cash flow, which you usually want a 1-to-1 or 1.0 and over.
And what that means, just for you guys watching, is the rent amount have to equal the mortgage payment amount, which taxes, insurance, principal, and interest. Correct?
Correct, but we do one caveat we have to that is if say it came in low, you still have some options, because typically we do have our 30-year PITI payment, our 30-year fixed, fully amortized payment. If you're just under cash flowing, you can option to go to a 40-year term, because that will reduce the payment a little bit. If that doesn't quite do it, you could also decide to go interest only, and we would qualify based on the interest only payment, taxes and insurance. So
you can do a DSCR with a interest only payment. Is that what you're saying?
Correct.
And normally, how How long is the loan amortized for? What's the term?
Well, the interest only term is 10 years. So it would be a 10-year term that would then convert over to fully amortized for the remaining 20. So we have a 30-year interest only and a 40-year. But the reality is, God willing, the rates will look better in a few years, and everybody will be refinancing out of those anyways.
Perfect. Are there any prepayment penalties associated with this type of loans?
There are. So pretty much whether it's DSCR or full doc or what be any type of investment property traditionally will come with a prepayment penalty. There are many different options of the prepayment penalty that will impact pricing. So again, that's one thing. If you ever are tight on the cash flowing, again, where you have your options, you may go for an extra year on the prepay because your rate comes down at that point, or you go less. But each one does have a prepayment penalty.
Perfect. So it could be from 3 to 5 years. Is that right?
Actually, the longest term is 5 years, but you can buy it all the way down to 0.
Got it.
So,
Okay.
yeah.
And one last question. Can you do a home equity loan with a bank, with a DSCR loan?
No,
No.
unfortunately, you can't, because it just a home equity loan by definition is a trade loan. So you do have to show ability to repay. Now we do have a couple different second mortgage programs, and one of those, our Olympic Second, is eligible for investment properties, but it is a full doc loan.
We'll do another of this podcast where you can talk about those second loans. So
my pleasure.
Thank you, David. Thank you so much for being on board. Thank you for spending this time with us. And you guys at home, if you need any loan products at all, feel free to reach out to me, and I'll definitely be able to help in the state of Florida and Kentucky. But I have some partners around the US that we can actually help as well. And if you want a product for us to discuss in here, definitely just type it in the notes, and I'll go ahead and look into it, and hopefully we can go ahead and discuss and give you some idea of how it all works. David, thank you so much. Guys, I'll see you next week. Bye-bye.
Thank you. Bye-bye. Thank you.